Welcome back to the webinar series. In today's session, I am planning to discuss two key important accounting standards. Thereafter, we will start comprehensive MCQ questions, which is the most important part of the session. Why? Because you know this is fully MCQ exam. I am repeating the same. Why? Because you need to understand it. Right? Fine. So, we will start with the first accounting standard, which is LKAS 37. So, LKAS 37 standard talks about three components, three elements. One is the provision, other one is contingent liabilities and contingent assets. We need to understand the difference between provision and contingent liabilities and contingent assets during this discussion, and how to account for provisions, and what is the accounting treatment for contingent liabilities and contingent assets. So, those are the key three elements that I am going to discuss during this session relating to this standard, right? Fine. So, we will start with the first element of this standard, which is provision. This is not a new standard for you all, I believe. In your A-level exam, to a certain level, this should have been there, I believe. If not, maybe in some other exams like AAT, you may have gone through this standard. Forget about all the knowledge you gathered, you have right now. Look at this standard with fresh mindset. Thereafter, you can compare with whatever the knowledge you have right now. Why I am telling like that, sometimes if you have some different view on this standard, why? Because you may have learned this standard in singular medium and maybe in some other languages or by using some other study material. Therefore, forget about everything and focus on this session and see whether there is any difference between the knowledge you have right now and the knowledge that you are going to take from this session. Why I am telling that, why I am giving that advice, you are at the beginning, at the initial stage of this journey. Therefore, you may not have enough comprehensive knowledge about this standard. Therefore, look at with fresh mindset. Fine. So, as I told you, we will start with provision, then we will move into contingent liabilities, and then we will move into contingent assets, right? Fine. The standard introduced in July 1999. The objective of this standard to prescribe the criteria for recognition and measurement of three things: provisions, contingent liabilities and contingent assets. For some elements, it is required only disclosure requirements. For others, it is required some accounting treatments. We will discuss, do not worry. The first topic or else first element of the standard is what? Provision. Out of three elements. What are the three elements? Provision, contingent liabilities and contingent assets. I would say the most important part of the standard is what? Provision. Right? Okay. The standard says provision means it is a liability. Provision means a liability. What do you mean by liability? Definition of liability we have discussed under what? Conceptual framework. When we go on through what? Elements of financial statements. There are 5 elements. Out of 5 elements, one is what? Liability. So, the standard says provision means it is a liability. Liability of uncertain time in or amount. We do not know the precise amount that we are going to pay. We do not know when we are going to pay. But anyway, it's a liability. Why we say it's a liability? Because provision, because the liability, to be a liability, it should be what? Present obligation. Right? Present obligation from what? Past event. If it is a present obligation that we have as a result of past event, and when you settle that obligation, if you have an obligation, you have to settle it. You have to deliver it. When you settle it or when you deliver it, if it's required, cash or else economic benefit outflow, if you expect any economic benefit outflow, that you will identify as what? A liability. That's a simple definition of a liability. There are three key parts in that definition. What are they? It's a present obligation as a result of past event. When you settle that obligation, you expect what? Outflow of economic benefits. That's the definition of liability. So, all these three conditions satisfy when it's come to what? Provisions as well. Therefore, provision also what? A liability. Provision also a liability. Why? It's a result of past event. You have a present obligation. When you settle that obligation, you expect outflow of economic benefits. Very clear. So, first thing you need to understand is what? Provision means a liability. Why? Provision satisfy the definition of liability. The next part, if it is from past event, that create present liability, that present liability or present obligation, not present liability, present obligation, create legal obligation or else constructive obligation. Right? I told you provision means a liability which arises from a past event and you have a present obligation. That obligation can be created through legally or constructively. Understand? What do you mean by legal obligation? Legal obligation means you don't have any choice. By law, you have to settle it. Example, let's say you release wastewater, you have an organization, right? Your organization released wastewater to the next land nearby, right? The owners of that land has taken legal actions against you, against your company. The court decided, yes, they have done something wrong, they have violated environmental laws and regulations, therefore, you have to pay penalties. Which means it is what? Legal obligation. That fulfill the definition of a liability also. Why? You have present obligation to pay some penalties. That penalty because of what? Past event. And when you settle that penalty, you expect what? Outflow of economic benefit. And it is what? A legal obligation. It's a legal obligation. Therefore, it's a provision and that obligation has created as a result of what? Legal obligation. Then, other side, constructive obligation. Right? Provision can be a legal create through legal obligation or constructive obligation. What do you mean by constructive obligation? It is coming from the practice of the organization. When I say practice, listen to this example. Let's say you are selling electrical appliances. Right? What are the similar organizations in this country? Let's say Singer, Abans, Softlogic, they are in the business of what? Selling electronic appliances. Let's say you purchase a TV or refrigerator from Singer or Abans or Softlogic. So they are giving you what? A warranty period. Within, let's say, 5 years or 10 years time, if there is any fault in the product, they will pay you what? Or they will repair at free. You only no need to pay anything. The company will come and do the repairs. If it is major defect, they will replace the item. The company is expecting some sort of repairs because of minor defects, or some appliances may be replaced as a result of what? Major defects. You do this repair and replacement as a practice in your business. In history also you have done some repairs and you have replaced some of the items. Therefore, through that practice, that has been created what? Constructive obligation. There is no legal obligation to settle that liability. But you have what? Constructive obligation. Why? In practice, in history, you have done that, you have given that service facility to your customers. Therefore, you estimate the history, repair and replacement rate based on historical data. You do what? Provisions for future events. Let's say you have done this much of sales, from that you expect this much of percentage as minor repairs or major repairs. Then for that amount you have to make a what? Provision. That is called constructive obligation. That's all about provision. In short, what you need to understand, provision is a liability of uncertain time in amount. We don't know how much we need to pay and when you are going to pay. But anyway, it's a liability. Why? Because liability definition is what? It's a present obligation as a result of past event out, and when you settle that obligation, you have to pay what? There's an outflow of economic benefit. That present obligation can be a legal obligation or constructive obligation. Understand? Fine. Now you may have this question. Provision is a liability. So then what is the difference between provision and the liability? That is also important to understand. Can be tested in this exam. Now if you look at this slide, provision is a liability of what? Uncertain time in an amount, time in O amount. Let's say creditors, liability. When you purchase raw material from your suppliers on credit basis, that will create what? Liability. Why? Because it's a past event. Presently you have obligation. When you settle that liability, there is an outflow of economic benefits. But understand, is there a uncertainty of timing? No. Suppliers will give you 30 days, 60 days credit period. So within that credit period you have to settle. There is no uncertainty when it's come to what? Timing. When it's come to normal liability. And the amount. When you purchase, let's say 1,000 worth of goods, your amount is what? 1,000. The liability is 1,000. Therefore, when it's come to liability, timing and the amount is not uncertain. But the provision, it's a liability, but the problem is what? It's a liability, it satisfies the definition of liability, but amount and the timing is uncertain. Both are uncertain. Maybe one or maybe both. Sometimes time can be uncertain, sometimes amount can be uncertain, sometimes both can be uncertain. But that satisfy what? Liability. Understand? Right. So that's the difference between provision and the liability. Right. So anyway, provision is a liability, that's a liability arise from past event, and you have present obligation. That obligation can be legal obligation or constructive obligation. Fine. I believe you have now good understanding about provision and the difference between provision and the liability. When to recognize provisions? When do you recognize provision? This is very, very important slide and simple. Right? That's why I told you, remove the existing knowledge you have, right, and focus on this. When to recognize a provision? Provision will be to recognize provision, it should be a present obligation. Why it should be a present obligation? Provision means a liability. Liability means it's a present obligation. And when you settle that obligation, economic benefit, outflow of economic benefit should be what? Probable. Important word is what? Probable. Examiner can use this word to mislead you, saying that possible. If you see that word possible, that is not a part of definition of what? Provision. The word should be what? Probable. When you settle that obligation, outflow of economic benefit should be what? Probable, not possible. Right? And the amount should be measured in a reliable way. You don't have precise amount at the moment, but that estimated amount should be what? Reliable estimate amount. When you satisfy these three, yes, when you satisfy all these three, look at this word, all conditions met. If these three conditions are met, what are the three conditions? It's a present obligation and probable outflow of economic benefits, and that outflow you can measure in a reliable way. If so, if these three conditions are, all these three conditions are satisfied, you recognize what? Provisions in your books. However, if one out of these three conditions are not satisfying, that's not a provision. Let's say you have present obligation, but outflow of economic benefit is not probable. Sometimes amount cannot be measured in a reliable way. If so, it is not a provision. If it is not a provision, since you have present obligation, what it is? It's a contingent liability, or may not be a contingent liability, but it's anyway not a provision. If it is not a provision, can be a contingent liability that we will discuss, don't worry, or else it can be what? Nothing. There is no provision or contingent liability if you don't satisfy with these three conditions. So, in short, what you need to understand from this slide, when to recognize revenue, when these three conditions are satisfied. All these three conditions are satisfied. It's a present obligation, probable outflow, and the reliable estimate. When you satisfy with these three conditions, yes, you can recognize provisions. Now, I will give you a solid example. In my previous example, I will use the same example, right? The owners of the land has filed a case against the company. Why? You have released waste water to the next land without treating them. The company lawyers are telling, yes, you have done something wrong. Therefore, most probably, right, 90% sure the court will give what? Wrong order, right? Wrong order. Sorry, order in unfavorable decisions to the company, not a favorable decisions. Therefore, you have to pay what? Some penalties. If so, lawyers can estimate that amount reliably, in a reliable way, and the cash outflow also probable. Why? Lawyers are telling you have to pay, because they know in and out of the case. They say you have to pay, and the amount you pay also they will measure in a reliable way. If so, you can make a provision. But lawyers are telling, since this is not a big issue, right, most probably you will not pay anything, right, there is no probable outflow, right. I am sure 80% or whatever the percentage, greater chance is there not paying. If so, the outflow of economic benefits are not probable, according to experts' comment. Who is the expert? Lawyers. If so, you will identify it as what? Contingent liabilities. Understand? Right? So, that depends on that. You have to read the given information properly and come to a conclusion, right. But anyway, to make a provision, these three conditions should be satisfied. If not, it can be a contingent liability or nothing. How to measure a provision? We discussed what is the definition of provision and when to recognize. Third one, how to measure a provision. How do you measure it? Standard says it should be what? Best estimate of expenditure to settle the obligation. What estimate? Best estimate. Because provision means what? It's an estimate. Amount, we can't say precisely, this is the amount that you need to settle, that you need to that you need to pay out as economic benefits. No. You don't have a precise amount. Therefore, provision means the best estimate of expenditure to settle the obligation. That best estimate, maybe accountant might not be able to do it. He can apply this accounting standard, but best estimate should come from whom? Maybe an expert will decide it. If it is court case against the company, they will decide it. Right? Estimated figure. Understand? Right? Fine. But anyway, it should be what? Best estimate of expenditure to settle the obligation. Estimates means what? Always it's what? Judgment. Estimation means it's judgment. Judgment will be subject to many assumptions. Those assumptions should be what? Reasonable. When those assumptions are reasonable, you can say that judgment, that amount is the best estimated amount of expenditure to settle the obligation. Based on that judgment, there are two ways to decide or calculate the provision, to measure the provision. One is expected value model. We will discuss one simple question. Other one is individual most likely outcome. Individual most likely outcome. What is the difference between these two? Expected value means, now let us say, we will discuss one simple question. If you are given warranty on the sales you made, sometimes you will expect minor repairs. Sometimes you will expect major repairs, which may require some replacement sometimes. Therefore, when you calculate provision, you have to consider how much is coming as a minor repairs, how much will come through major repairs. Then you will calculate expected value based on probability. Expected value means probability theory, provision. You calculate provision based on what? Probability theory, which is expected value. Individual most likely outcome means what? In my example, legal case against the company, right? There is no expected value, which means there is no much more outcomes. Only one scenario. Lawyers will say this much you have to pay. That's also the estimate, but it is not. It doesn't involve many scenarios like warranty. Warranty has two scenarios, minor repairs and major repairs. Therefore, you have to calculate what? Expected value by using probability theory. But in this case, if it is legal case, it is individual most likely outcome. Why? Because you don't have much more outcomes out of that. Only one outcome, whether to pay or not. Right? Fine. In short, how do you measure provisions? That should be best estimates of expenditure to settle the obligation. And best estimate means that it's a judgment. Based on judgment, provision can be calculated using expected value when you have many outcomes, and if not, individual most likely outcomes. When you measure the provision, you have to consider 4 factors. One is risk and uncertainties. Second one, present value of future obligation, because this obligation will settle in future. Therefore, today you have to recognize what? Present value of that obligation. And future events also you have to consider, and no gain or loss from disposal of assets, which means gain from disposal of assets will not be considered, which means risk and uncertainties you can understand, right? Risk and uncertainties means in future when you settle this, it's subject to uncertainties, right? And it's anyway it's a future events. You do provision for future events, right? And since it's future events, you have to calculate today the present value of that future events when you measure the provisions, right? Look at my example. Someone has filed against a court case against the company. There's a risk of losing or risk of winning this case. That depends on the evidence, or that depends on the way you handle the case. That depends on the strength of the evidence, risk and uncertainties. The decisions will come in future. Because of that, we identify it as what? Future events. Since the settlement in future, today you have to recognize what? Present value of that. And any gain or loss of disposal of assets will not be recognized, or will not considered for what? Provisioning. Which means, now let's say you sold refrigerator, there is a major defect in that refrigerator, therefore you decided to replace it. But the item with defect, when you receive from the customer, you can sell it by doing some repairs. So that sales proceed we will not consider for what? Provisions when you make a provision. Understand? The defect product you can repair and resell it to another one at a discounted price. That selling price you will not consider. That's what? Not selling price. Gain from the disposal of asset you will not consider when you measure the provision. Clear? That's the way of measuring provision. 1 minute to summarize the entire statement. So, best estimate of expenditure to settle the obligation, and it's a judgment. Based on judgment, you can calculate provision using expected value method or individual most likely outcome. Since the obligation settle in future, always it has risk and uncertainties. It will happen in future, therefore it's a future events. Since it's future events, you have present obligation, you have to calculate the present value of that obligation, and any gain from disposal of assets will not considered for provision, measuring provisions. Clear? Look at this example. This electric company sells goods with a warranty under which customers are covered for the cost of repairs of any manufacturing defects that becomes apparent within the first 6 months of the purchase. The company past experience and future expectation, future events, right? It's a result of past event, but future expectation indicate the following pattern of likely repairs. If you go back to the previous slide, it's a future events, right? Future events. So, future expectation indicate following patterns of repairs. First of all, you have to understand whether it's coming under this definition of provision. So, to be a provision, it's a liability, right? Yes, it is a liability. If so, do you have present obligation? Yes, you have present obligation. That present obligations comes from legal or constructive. There is no legal obligation here. It is what? Constructive obligation. Why it is constructive obligations? This question says the company past experience and future expectation that follow in patterns. In history, they have given this provision, given this warranty facility. Therefore, this is not a legal obligation. This is a warranty, and this is a constructive obligation. Right? So then you have to measure a provision using the best estimate. So best estimate means a judgment using expected value or most likely individual most likely outcome. Here there is no individual most likely outcome. Why? Because here you have two scenarios, three outcomes, not two, three outcomes. What are the three outcomes? When you solve goods, 75% of them with no defects. How do you say that? Based on past experience. 20% of goods sold with minor defects. Right? So, cost of repair, if all items suffered from these defects, what? 1 million. So, 1 million is the repair cost if it is minor defects. To have minor defects, chance, probability 20%. Percentage of goods sold 5%, right? 5%. From 5% you expect what? Major defects, right? When you sell 20% of goods out of 100, you expect minor defects, 5% major defects. So repair cost 4 million, 75% no defects. So by using expected value you have to calculate provision. How do you calculate it? Now look at this, very simple, expected value method, simple calculation you have. 75% of the goods sold with minor defects, sorry, zero defects, 0%, right, no defects, plus 20% of the goods sold with minor defects. Repair cost how much? 1 million. I think millions, right? Yes. 5% of the goods sold with major defects, 4 million is the repair cost. Here no defects, here minor defects, and here major defects. Now calculate the provision, right? %20 into 1 million, 0.2 million, here 0, here 5% into 2, sorry 4, 0.2 million, right? So all together expected value 0.4 million. This is the amount you should recognize in the financial statement as what? Provision. Simple calculation, expected value method. Why? Because you are expecting no defects, you are expecting minor defects, you are expecting major defects. There are three outcomes. Since you have many outcomes, it is not individually precise, individually most likely outcome. It is what? Expected value method. This is the best estimate. Best estimate, it is a judgment from, it's a judgment, 75% judgment, 20% judgment, 5% judgment. By using this judgment, this is the best estimate that you can measure best estimate of what? Provision. Simple calculations, right? Fine. Coming back to the presentation, we have done that calculation, right? Expected disposal and reimbursement. I told you, gain from expected disposal of assets should not be taken into account in measuring provision. Right? Let's say in this example, so these major defects, you replace the items and you do some repairs and sell it. So those, the gain from that, gain you arise from selling those assets, you will not consider for what? Measuring the provision. Right? Expected disposal of assets. Any gain from expected disposal of assets should not be taken into account in measuring provisions. Then reimbursement. Some or all of the expenditure needed to settle the provision may be expected to receive from third party. If so, reimbursement should be recognized only when it's virtually certain. Underline the word, highlight the word, virtually certain. You can recognize that as an asset what? When it's virtually certain that reimbursement will be received if the entity settles the obligation. Which means sometimes the expenditure need to settle the provision. Always when you settle that provision, you are expecting outflow of economic benefits. That outflow expected to be recovered from a third party. Sometimes that outflow you will expect to recover from a third party. Right? If so, the reimbursement should be recognized only when it's virtually certain. ඔයා එක recognize කරගන්න හරියටම certain virtually certain වුණොත් විතරයි. Uncertainty එකක් තියෙනවා නම් you will not recognize as a what? Assets. The reimbursement should be treated as separate asset. It's not, you can't set off against the provision. That should be recognized as what? Separate asset. And amount recognized should not be greater than the provision itself. I'll explain using example, don't worry. The provision and the amount recognized for reimbursement may be setting off in profit and loss. Provision you will charge to P&L as an expense, we will discuss in next slide. When that receivable you will recognize as what? Gain in the P&L. So you have charge to P&L and you have a gain to P&L. So without recognizing that as a charge and the credit or debit and credit in P&L, you can recognize the net figure in the P&L. Good example. Now let's say Singer do some repairs or replacements for defects or products. From other company, they are expecting to receive that repair cost or replacement cost. That's a receivable for Singer. When it's virtually certain, they will recognize that as what? Separate asset. What is that asset? Receivable. You do some repairs, that repair cost is receivable from their mother company, let's say from Japan. So that can be recognized as an asset when it's virtually certain. However, you can't recognize that receivable greater than what? Provisions. Let's say to do some repairs and replacement you spend 1 million rupees. You are expecting to recover 1.5 million. Reimbursement should be treated as separate asset. That amount recognized should not be greater than provision. You can't recognize that receivable greater than the provision. The receivable maximum should be limited to what? Provision in amount. Then that amount recognized for reimbursement may be net off against the net off in the profit and loss account. Provision amount and the reimbursement amount. Simple, right? Fine. So what is the learning outcome from this slide? Any disposal gain or gain you will not consider for disposal gain from assets, you will not consider for provisions. Reimbursements, yes, you can identify it as a receivable when it's virtually certain, but that receivable amount should not be more than the provision. Those are the MCQ points. And in P&L you can recognize the net amount. Change in provisions, very important again. There are questions from this area also, we will discuss. Change in provision, read this. Provision should be reviewed at the end of each reporting period. Highlight, very important phase is what? At the end of, review at the end of each reporting period. You have to review at the end of each reporting period and adjusted to reflect the current best estimate. You have to adjust to reflect the current best estimate. If it is no longer probable that transfer of resource will be required to settle the obligation, the provision should be reversed. Right? Example. Now let us say there is a case against the company. Lawyers are in the view of that company need to pay some money, therefore you made a provision. But because of the weak actions that other party has taken, the decision is going to give in favor of the company. Now lawyers are telling, even though we expected cash penalties or whatever, now since other party is not taking necessary actions against us, most probably we will win the case. Therefore, if so, there is no probable economic benefit outflow. Then you do what? Reverse the provision. Or else, sometimes the amount that you have provided may be different when it's come to the end of reporting period based on the evidence you have. Therefore, what you need to understand, any change, to see if there is any change, you need to review the provision provided amount at the end of each reporting period, and if it is no longer probable, you have to reverse the provision. Done. That is the basic part of the provision. Before we move into contingent liabilities and contingent asset, this slide also very important, that is there in your study pack and can use for what? MCQ questions. Important, but need to understand very carefully. Right? Listen to me, otherwise if you are in your own world, you might not be able to understand this properly, even though you understand provision, basic provisioning part of the session easily. Right? Future operating losses, onerous contract and restructuring. 3 terms here. The question is whether we need to make a provision for future operating losses, do we need to make a provision for onerous contract, or do we need to make a provision for what? Restructuring. We will take one by one. Future operating losses. Future operating losses. In future you are expecting operation losses. Do we need to make a provision? No. Why? Because it is not a liability. It is not a liability. Provision means a liability. Why it is a liability? You have a present obligation as a result of past event. Future operating losses is not due to what? Past event, and you do not have what? Obligation today. Do we need to settle something in future for future operating losses? No. Since it is not a liability, it is not meet the definition of liability, it is not a provision. No provisions will be recognized for what? Future operating losses. But if there is any impairment relating to assets, that you have to recognize. What do you mean by impairment? Carrying amount is higher than the recoverable amount. In future you will enjoy, you will experience future operating losses. Today, therefore, today your assets may be impaired, which means carrying amount of assets may be higher than recoverable amount. If so, you have to identify that impairment loss in your books, but no provision for future operating losses. Onerous contract. What do you mean by onerous contract? Onerous contract means right? You have an unavoidable cost of fulfilling the contract. Unavoidable cost fulfilling the contract is higher than the economic benefit of the contract. If so, we identify it as what? Onerous contract, right? Onerous contract. If there is an onerous contract, you can make a provision, yes. We'll come to example, don't worry, right? You can make a provision, but that provision should be lower of what? Net cost of fulfilling the contract or penalty, whichever is lower. Lower of net cost of fulfilling the contract and the penalty. Look at this example, right? Look at this example. Right. You have rented a building, right, for 5 years period, right? Year 0 to 5, year 5. So, each and every year you pay, let's say 1, 2, 3, 4, 5, right? 1, 2, 3, 4 and 5th year. Every year you pay 100,000 rupees. Simple example. Here you are at the end of second year, let's say second year. According to the agreement, you have to pay 100,000 rupees every year. So when it's come to second year, you have already paid 200,000 rupees you have paid, and balance 3 years, for balance 3 years you have to pay how much? 300,000. So this 300,000, you have an option. Either, now let's say this is the cost to the company, rent cost. The economic benefit of this rented premises, right? 200,000, let's say, or let's say 250,000. From this building, the economic benefits you take limit to 250,000 while you are paying 300,000. Now, unavoidable cost, you can't say I can't pay this money, no. You have to pay this 300,000. Is higher than the economic benefits. This is identified as what? Onerous contract. Onerous contract. Cost of fulfilling the contract is higher than the economic benefits. This is unavoidable cost. How do we make the provision? Yes, you can make a provision, right? Provision should be lower of these two. Net cost of fulfilling the contract. So the cost of fulfilling the contract, how much? 300,000. This is the cost of fulfilling the contract. That should be net cost, right? Net cost, let's say your net cost, not that's the cost of fulfilling the contract, net cost 50,000. Why? Your cost 300,000, economic benefit 250,000, the net cost of fulfilling the contract 50,000. If you don't continue this, let's say you decided at the end of second year, since you have a loss of continuing this contract, right, you decided to stop this contract. So you can't do it as you wish. Alright, since you are making losses, I can't rent this building, take this building, I don't want it. The owner of this building say, right, okay, you can stop this contract, right? If so, you pay me penalty how much? 60,000. You pay me 60,000. So the provision should be maximum how much? Limit to lower of these two, right? Penalty and the net cost of fulfilling the contract. This is the net cost of fulfilling the contract. This is the penalty. So, lower of this is what? Provision should be 50,000. 50,000, you have to make a provision. Simple. This is onerous contract. Onerous contract means your carrying amount, economic benefit is higher than unavoidable cost. If so, that contract we identify as onerous contract. Then you can make a provision. Provision should be lower of net cost of settling the contract and the penalty whichever is lower. Right? Fine. Very simple. Coming back to the slide, presentation. Third one, restructuring. Simply understand, for restructuring also you can make a provision. But first of all, you need to understand what you mean by restructuring. Restructuring means, I will come to this slide again, but first of all we need to understand restructuring. LKAS 37 standard says, the following are the example of events that may fall under the definition of restructuring. Restructuring means your business you are going to restructure in future, right? So, these are the examples. So, then you will easily understand what is the definition of restructuring. Sale or termination of line of business. What do you mean by line of business? You have 3 products, right? You are manufacturing, let's say, marker pens, you stationery supply, you are a stationery manufacturer. Marker pens, you manufacture A4 sheets, you manufacture let's say exercise book. You stop the business of exercise book. You continue with marker pens and some other stationery items. You stop one line of business, which will come under what? Restructuring. Second one, the closure of business location in a country or region, or relocate the business activities from one country to region or another, from one country or region to another. Let us say you have business in India. You decided to close that business and you will start that business in where? Australia. That is restructuring. You close down some business in some regions and start in some other locations, right? Third one, change in the management structure. Example, eliminating layer of management. Good example I can give you. Let's say in organization structure you have managers, thereafter you have senior managers, thereafter you have deputy general managers, then you have general managers. The organization has taken a decision to remove one layer of management. Let's say from 2021 onwards, there is no management category called deputy general managers. Only you have manager, senior manager and the general manager. They have eliminated deputy general manager category. That is also will come under what? Definition of restructuring, right? Next one, fundamentals of the organization, reorganization that have material effect on the nature or focus of the business operation. There are some fundamental reorganization. As a result of that, the nature and the focus of the operation has been changed. Nature of the business if change and the focus of the business of also if change, that is what? Fundamental reorganization. That is also restructuring, right? Fine. So, those 4 are the example for restructuring. If so, you can consider the cost related to this restructuring for what? As you can make provisions on behalf of this restructuring in short. Standard says to recognize provisions. Look at this slide again. To recognize provision for restructuring, the program planned and there should be a program plan. There should be a plan for restructuring. Highlight this. There should be a plan, and that plan should be controlled by the entity that change the scope or manner of the business, which means there should be detailed business plan to make a provision. For future restructuring, there should be a detailed business plan. Detailed plan. You can say from 2021 onwards we are going to close down India operation and we are going to establish that in Australia. There is no time. They have not identified who are the people affected because of that, and there is no precise time period. They have not estimated cost of dismantling and establishing Australia new business. Nothing. It's only about decision. There is no proper plan, detailed plan. If so, you can't make a provision. And valid expectation. There should be a valid expectation. Even though you have a detailed plan, there is no valid expectation that they are going to do this restructuring. If so, you can't make a provision. To make a provision for restructuring, for those examples that we have discussed, there should be a detailed plan as well as valid expectation on that detailed plan. Right? Fine. Now look at this slide. That explains this slide. A constructive obligation to restructure arises only when A has a detailed formal plan, B has raised a valid expectation. There should be a detailed plan and the valid expectation can be tested. Be careful, right? What do you mean by detailed plan? How can we conclude that they are saying there is a detailed plan? To say there is a detailed plan, these should be satisfied. First one, the business has detailed plan that restructuring identified at least these: the business or part of the business concern, principal location affected because of this restructuring. What are the locations that going to be affected? And the locations, functions, approximate number of people who will compensated for terminating their service. Because of restructuring, sometimes people will lose their jobs. That also they have identified in their detailed plan. And the expectation that will be undertaken. The expenditures that will be undertaken also should be there in the detailed plan. And finally, when the plan will be implemented, when you are going to implement this plan, timelines. When you to have a detailed plan, to say there is a detailed plan, at least these 5 factors to be there. B has valid expectation. What do you mean by valid expectation? In those affected, that it will carry out the restructuring by starting to implement that plan or announcing the main features of those affected by. You have a detailed plan. That detailed plan is there with whom? Only the board of directors. Employees and other people who affect because of this restructuring is not aware about this. You have not properly communicated this to relevant parties. If so, you can't make a provision. When you communicate only, that will create what? Valid expectation that company is going to do this restructuring. So when you have a detailed plan and valid expectation that they are going to do this restructuring, yes, you can make a provision for restructuring. In short, for future operating losses, you can't make a provision. Why? Because it's not a liability. For onerous contract and restructuring, yes, you can make a provision. Fine. So these are the costs that you can recognize for making provisions for what? Restructuring. LKAS state that restructuring provision should include only direct expenditure. Make a note. Direct expenditure that necessarily entitled by the restructuring and not associated with ongoing activities. Any cost not associated with ongoing activities also you can consider for what? Provisioning. However, following costs specifically not be included within the restructuring provision. What are they? Retraining or locating continuing staff, right? Retraining staff cost, marketing cost and investment in new system. Those 3 elements according to LKAS 37 will not be a part of restructuring cost. Retraining cost, marketing cost and the investment in new systems. What do you mean by retraining, marketing and investment costs. Let's say you remove your business from India and going to start a business in Australia. So then you have to do what? Marketing activities. That cost you will not consider for restructuring. And retraining and relocating staff, relocating continuing staff. So the same staff you will take to new business also. If you retain, that cost will not be part of restructuring. Investment in new system. Sometimes the existing system you might not be able to use in new business line. If so, that is also will not be a part of, you have to incur new cost on new system, that will not be part of the provision. Fine, we have done first part of the standard, which is provision, right? We identified in short definition of provision, when to recognize provision, what is the accounting treatment for provision, and can we make provision for future operating losses, onerous contract and restructuring. Finally, contingent asset and contingent liabilities. The common word here for both, contingent. What do you mean by contingent? Contingent means you cannot establish amount of economic benefit that will flow out from the organization. That is no reliable estimate on that. And the future events also not probable, may be possible but not probable. If it is not probable and if you can't make reliable estimate on that obligation, you will not recognize provision and it will become under the definition of contingent liabilities, or if it is receivable, it will be contingent assets. Look at this. It's a possible obligation, contingent liabilities. Look at contingent liabilities first. It's a possible obligation, not a probable obligation. If it is probable obligation, yes, you will recognize provision, since that present obligation is possible obligation. So present obligation, yes, you have present obligation, but it is probable, it's not a probable obligation, it's a possible obligation. Outflow not probable or not reliably measured, therefore no provisions will be recognized for contingent liabilities. Then it's required only the disclosures. You can't ignore completely, you have to do what? Disclosures. Why? It is not probable and amount cannot be measured reliably. If amount cannot be measured reliably and if it is not probable cash outflow, you can't make a provision even though you have present obligation. When it's come to contingent assets, right? Contingent assets, look at this definition. Contingent assets, contingent liabilities we discussed. The possible obligation that arise from past events and whose existence will be confirmed only by occurrence or non-occurrence of none or one or more uncertain future events not wholly within the control of entity. It's beyond the control of entity. Therefore, it's not probable, an amount of that cannot be measured reliably. Therefore, no provision will be recognized for contingent liabilities, but disclosure required. Contingent assets says it's a possible assets that arise from past event whose existence will be confirmed by occurrence or non-occurrence of one or more uncertain future events not wholly within the control of entity, right? So that receivable is not virtually certain. If it is virtually certain, yes, you will recognize that as an asset. If it is not virtually certain, why it is not virtually certain? The receivable depends on occurrence or non-occurrence of many activities, and it is not within the control of entity. If it is not within the control of entity, anyway, you can't recognize asset. Why? Because definition of asset says it should be controlled by the entity, right? Therefore, for both contingent liabilities and contingent assets, no provisions will be recognized, nothing will be recognized in books, but only disclosures will be done. In short, contingent liabilities will not be recognized. Why? It's not a probable obligation, it's a possible obligation, and amount cannot be measured reliably, as well as outflow is not probable. Therefore, disclosures only. Contingent assets, its receivable is not virtually certain, and the receivable depends on depends on many uncertainties, one or more uncertainties, occurrence events, one or more events, and those outside the control of the entity. Therefore, no provisions, nothing will be recognized in books for contingent liabilities and contingent assets. Example, right? A company is engaged in legal disputes. Now we have done the standard, theoretical part of the standard we have done. Contingent liabilities, contingent assets and provision. 3 elements we have gone through. Now it's time to discuss some examples from your study pack. A company is engaged in the legal dispute. The outcome is not yet unknown, not yet known. Number of possibilities arise like this. It expect to have to pay about 1 million. If so, it's a provision. Possible damage of 1 million, but not expected to have pay within them. Therefore, it's contingent liability. Why it is? Not probable, possible. A company expects to have to pay damages, but unable to estimate the amount. Again, it's what? Contingent liability. Why? Because amount, the payments, the settlement is not reliably measurable. Therefore, you can't make a provision. In both cases, contingent liabilities. The company expects to receive damage 1 million and this virtually certain. If it is virtually certain, highlight it. Virtually certain නම් asset එකක් recognize කරගන්න පුළුවන්. No issue. Next one, the company expect probably receive damage 1 million. Probably contingent asset will be disclosed. Company thinks it may receive damages, but it is not probable, nothing to do, ignore it. So highlight these words. In first bullet point, expect to pay, expects to have to pay, because of that provision will be recognized. Possible damage, then contingent liabilities. Third one, unable to estimate, because of that contingent liabilities. Company expect to pay and virtually certain, therefore next one, asset will be recognized. Next one, company expect to probably receive damage, therefore contingent asset will be disclosed, and may receive damage, there is no greater chance to receive, therefore nothing to do with that. Simple example to explain all the outcome of the standard. Examples of provisions. These are the examples for what? Provisions. Warranties, major repairs, self-insurance, environmental contaminations, commissioning and abandonment of cost, restructuring. These are the examples for provisions. Can be tested, that's why included. Fine. We have done the theory part. Now it's very important part of the discussion. I have 10 MCQ questions, right? Look at this. 10 MCQ questions. These all questions are from ACCA exams. I told you exam is similar to ACCA syllabus. Since you don't have much more questions to practice MCQ questions, you have to refer what? ACCA guidelines, ACCA model questions. Then only you can figure out, then only you can ready for your exams, right? Fine. There are 10 MCQ questions. If you can handle these 10 MCQ questions, yes, it's not a big deal to pass this exam. We'll take one by one. This is the most interesting, important part of the session. Why? This will test your understanding about LKAS 37. Fine. We'll go through one by one. Question number 1. Which of the following, I'll tell you how to answer this question. There's a logic when you select the right answer, because all answers can be similar when you read this. You have to carefully figure out the correct answer. Which of the following statement about provision and contingencies are correct? There are three statements. Examiner is asking the correct statement or statements. First one, a company should disclose detail of change in carrying value of the provision from beginning to end of the year. If you can remember, go back to our previous slides. There is a slide called what? Change in provision. In that slide, we have clearly understand, yes, opening provision, closing provision we have to figure out. The difference of that you have to charge to P&L, which means at the end of each reporting period, you need to reassess whether it's required changes to provision, which means statement number 1 is correct. Be smart when you answer this question. Since you are sure about statement 1, you can remove all the answers if point number 1 is not included. Therefore, answer A and B you can easily remove. No need to read even. Then the challenge is A and C and D. When you look at C and D, how do you smartly select? All three statements are correct. මේ තුනම හරියන්නත් පුළුවන්. නැත්නම් only 1 and 3. Doubt is only about what? Second statement. Definitely without reading all these three statements, you can come to a conclusion. Smart students only can do this. Without reading this, you can say statement 3 should be correct. Why? You removed answer A and B. Why? Because you are sure about statement 1. Statement 1 is included in answer C, but statement 2 is not there. 3 is also there, definitely, therefore 3 should be correct. Why? Answer D also said all these 3 are correct. Therefore, third statement must be correct. Read third statement before we come to second. Contingent liabilities must be treated as actual liabilities. Must be treated as actual liabilities and provided for if it is probable that will arise. Important word is what in this statement? Not anything other than the probable. If the word is possible, answer is wrong. Since the word is there probable, answer is correct. Contingent liability must be treated as actual liability and provided for if it is what? Probable, not possible. Examiner can do a small change, your examiner saying that is possible. Be careful when you select the word. Highlight, make a note. Probable, because the word is there probable, answer is correct. Now, to see A, C or D, read the second statement. Contingent assets must be recognized in the financial statement in accordance with the prudence concept. Completely wrong. We discussed few minutes ago, contingent assets will not be recognized. Therefore, answer is what? C, 1 and 3. Question number 2. Which of the following statements about contingent assets and contingent liabilities are correct? Examiner is tested in two parts of the standard, contingent liabilities and contingent assets. Right? There are 4 statements. Out of 4, only 2 statements or 3 statements will be correct. Why? Because if you look at answers, the combination of 2 and 3 statements are there. Right? Read this. Contingent assets should be disclosed by not if an inflow of economic benefits are probable. Correct. Contingent assets should be disclosed. If it is probable, fine. But if it is virtually certain, yes, you can recognize asset. Other than that, you have to disclose. Correct. Statement 1, correct. Second one, contingent liability should be disclosed by not if it is probable that transfer of economic benefits to settle it will be required. with no provision being made. Correct or wrong? Contingent liabilities should be disclosed by or not if it is probable that transfer of economic benefits to settle it will be required with no provision being made. බැලු බැලමට නම් හරි වගේ තේරෙන්නේ. You may think alright it's correct. No. Why? Look at the word probable. If it is probable, no need to disclose. You have to recognize as what? Provision in the financial statement. Therefore, answer 2 is statement 2 is wrong. Right? Fine. Third statement. Third statement says no disclosure is required for contingent liability if it is probable that transfer of benefit should settle the asset is required. No disclosure required for contingent liabilities. If not probable, definitely what? You have to disclose it. But this statement says no disclosure required. Be careful with these answers. They are playing with the word called what? Probable. Right? No disclosure is required for a contingent liability if it is not probable. If it is not probable, definitely it is what? Possible. If so, for that present obligation, you have to make what? Disclosures. Statement 3 is wrong. It's required disclosures. Why? It is not probable. If it is probable, you have to make provisions. If it is not probable, disclose. Therefore, no disclosure requirements, that phase is wrong. No disclosure is required for either contingent liability or contingent assets if likelihood payment or received is remote. Completely wrong. Completely correct. Why? No disclosure required or contingent liability or no disclosure required for either contingent liability or contingent asset if likelihood of payment or receipt is remote. Yes, if the likelihood of payment or receipt is remote, no disclosure or required for contingent liability or contingent asset. Why? It's not a contingent liability or contingent assets then. Right? Therefore, answer is what? Statement 1 is correct. Statement 4 is correct. Therefore, answer to second question is what? A. Correct answer is A. So, read the question number 3. An ex-director of X company, previous director, right? Previous director has commenced an action against the company claiming substantial damages for wrongful dismissal. The company solicitors have advised that ex-directors unlikely to succeed his claim. Although the chance of X paying any monies to ex-directors is not remote, underline the words, not remote. The solicitors estimate the company's potential liabilities are legal cost how much? 50,000. Settlement of claim if successful, 50,000. According to LKAS 37, provision contingent liabilities contingent, how this claim should be treated in the financial statement, right? Provision of 550,000. Do we need to make a provision for 550,000? First of all, you have to figure out whether it's required provision or not. Look at this sentence in the question. Although a chance of paying monies to ex-director is not remote, right? If I start that statement, the ex-directors, ex-company solicitors, mutual legal advisors, has advised that ex-director is unlikely to succeed with his claim, unlikely to succeed with his claim, although the chance of expaying any monies to director is not remote. If it is not remote, you have to make a what? Provision, right? So, how much you make for how much you made a provision is the question, right? Here, sorry, you will not, for some expenses you will make a provision, for some you will not make a provision. How do you figure it out? Provision for 550,000. So, this 550,000 consists of two things. Legal cost to be incurred whether claim is successful or not. Whether you successful or not, 50,000 you have to incur. For that 50,000 you have to make a what? Provision, definitely. Whether you win or lose this case is a different story, but you have to pay 50,000. Present obligation you have as a result of past event, and that amount you can measure reliably. But the second one, settlement of claim if successful. If successful, you have to make what? 500,000 payment. But to successful this case, it is, the chance is very low. Lawyers are telling X company is unlikely to succeed this claim. X director will not win this case, unlikely, right? There is no probable cash outflow. Since there is no probable cash outflow, even though you measured that in a reliable way, no provisions will be recognized. If you can remember, should be a present obligation, probable outflow, reliable estimate. Here reliable estimate is there, obligation also there, but not probable, right? Question says unlikely to succeed this case. Therefore, settlement of case if successful, you will not make a provision, you will do what? Disclosures for that. For 50,000 you have to make a provision. Why? Because as a result of past event, present you have obligation, you can measure it reliably, cash flow also probable, right? Therefore, 50,000 you make a provision. For settling case, if successful, you don't make a provision, right? Therefore, answer, provision 50,000 wrong. Disclosure contingent liability, both are not contingent liability, 50,000 is a provision, second one is contingent liability. Answer C, disclosure, provision of 50,000 and contingent liability of 50,000. That's the correct answer. Provision of 50,000 and contingent liability 500,000. That is the correct answer. Provision 500,000 wrong, contingent liability 50,000 wrong, right? So answer is what? C. Question number 4. Following items have been disclosed, the following items have to be considered in finalizing the financial statement of Q, the limited liability company. The question is this: according to LKAS 37, provision contingent liabilities contingent asset, what is the correct action that they need to take for these two items? There are two items, they are asking correct accounting treatment, right? Statement 1, the company gives warranty on its product. The company statistics shows 5% of sales will arise warranty claim. Therefore, you have to make a provision. So then, answer A says create provision for number 1, yes. Read second also. Company has guaranteed the overdraft of another company. The likelihood of liability arising under guarantee is assessed as possible, not probable. If it is probable, it's a provision, but since it's a possible thing, you have to disclose, right? Very important word in the second statement is what? Possible, not probable. If it is probable, provision. Since it's possible, only a disclosure. So then answer is what? A. First one creates a provision, second one make a disclosures. Question number 5. Which of the following statements about requirement of IAS 37, since it's IAS, ACCA from IAS they have mentioned, but in your exam it will be LKAS 37. Provision, contingent liabilities and contingent assets. Correct statement, correct, they are asking, right? There are 3 statements, you have to select the correct statement. Contingent asset should be disclosed by not if inflows of economic benefits are probable, correct. But if it is virtually certain, it's asset. Since they are not talking about virtually certain things, it is probable, contingent assets should be disclosed. No disclosure of contingent liability is required if the possibility of transfer of economic benefit arise is remote. If it is remote and if there is no possibility, no need to disclose. Second one also correct. Important word is what? No disclosure of contingent liability if it is required what? Possibility of transfer of economic benefits arising is remote. Right? Third one, contingent assets must be recognized in the financial statement unless the economic benefits virtually certain are. Very important word is what? Virtually certain. If it is virtually certain, contingent assets will be recognized, but contingent assets must be recognized. If it is virtually certain, asset will be recognized. If it is virtually not certain, this statement is correct. Contingent assets must not be recognized in the financial statement unless inflows of economic benefits virtually certain. Right? Fine. If it is virtually certain, recognize. If it is not, only disclosure is required. Right? So then all these three are correct. Therefore, answer is what? All three statements are correct. Question number 6. The company allows customers to return false goods within 14 days of purchase at 30th November 2005. A provision of 6,548 was made for sales returns. At 30th November, the provision was recalculated, should be how much? 7,634. So, what should be the reported in company statement of profit and loss account, right? So, at the beginning of the year, you have 6,000 credit balance. At the end of the year, 7,634 provision has been increased from 5,000. The difference 7,634 minus 6,548. The provision should have been has been increased. Therefore, additional provision should be recognized in the P&L. Therefore, you have to charge 1,086 rupee dollars in P&L as a charge. So, answer is what? C. Question number 7. Company is a dogged company is a business of selling second-hand cars. If a car develops a fault within 30 days of sales, dogged company will repair it free of charge, right? If it is within 30 days, free of charge. At 30th April 2000, whatever the year, 14 or 4, the company has made a provision of 2,500. At 30th April 2015, after 1 year, the provision calculated 2,000. So, that provision has been reduced based on the experience. So, there is a gain to P&L then. So, answer should be what? The difference 500,000 should be credit to P&L. So, question number 7 answer is credit 500,000 to P&L. Simple. Question number 8. Which of the following best describe provision according to this standard? Right. Question number 8. Provision is a liability of uncertain time in amount. Look at the first slide. Yes, correct. Then no need to read other slides even. Right. Provision is a possible obligation. Complete loan, it's a probable obligation. Provision is a credit balance set up to offset contingent asset. Completely wrong. Provision is a possible asset. Completely wrong. Answer is A. 12.9. Question number 9 basically. Which of the following item does the statement does the statement below describe? There are 4 answers. Look at the statement first. A possible obligation that arises from past events and whose existence will be confirmed only by occurrence or non-occurrence of one or more uncertain future events or wholly within the entity's control, which is what? Contingent liability, right? Last question. Montage Paint Shop has suffered some bad publicity as a result of a customer claiming to be suffering from skin rashes as a result of using the new brand of paint sold by this company. The customer launched a court case against the company in 2013. Company damage, they are the claiming damage of $5,000. The lawyers has advised him most probable outcome that will have to pay 3,000. So then answer is what? You have to make a provision for 3,000. Question is what? What the amount the company include in provision in their financial statement? Simple, $3,000. So 10 MCQ questions we have done and 3 element of standard we have done: provision, contingent liabilities, contingent assets, theory, everything with examples. Since we have done 10 MCQ questions, the next exam question will not be a challenge for you all, right? Fine. We will move into discuss next accounting standard.